Hello guys, and welcome back to H Invest. Today, very exciting stock analysis. We're doing Altria. This was actually a request by one of the subscribers, AS. So thank you for that. It's a stock I've been looking at myself. And without further ado, let's get into it. Okay, so who are Altria? A lot of people probably know more their brands than the name. They're basically a large American tobacco company headquartered in Virginia. They own the Marlboro brand, which is obviously, it has a very big share of the cigarette market. Basically, what happened is Altria is a spin-off. So there was Philip Morris, who was a big tobacco company, and it divided into Altria and Philip Morris International. The thing you've got to remember about this is that Altria is completely US and exclusively US, and then Philip Morris International is completely international. They've also got a number of different brands. So they've got not just cigarettes, they've got smokeless tobacco, Michelle Wine, a 35% stake in JUUL. I'm sure a lot of you guys know JUUL. That's e-cigarettes. 45% stake in Cronos, which is the cannabis market. And then also a 10.2% stake in Anheuser-Busch in Bev, who's like the world's largest brewer. They make Corona beer, Amstel, all kinds of brands of beer. So that's Altria. Why Altria? Why cigarettes in this tech world that we're currently living in? Okay, so it's because it's an undervalued dividend play. The yield is 8.2%, which is absolutely massive. And the thing I love about very high dividend yielding stocks is they offer a very capped downside. What I mean by that is that as long as the dividend isn't going to be cut, the market just isn't going to bid down the share, you know, to its 20% yield. It wouldn't, because otherwise income investors would just go crazy and bid the share price back up. That's what I like about the Altria share, is that the yield is so high and I have confidence the dividend isn't going to be cut. It makes this capped downside on the stock. So the dividend has grown every year since 2008 sustainably. You work out the sustainably thing by looking at their dividend payout ratio and their free cash flow cover of their dividend, making sure we're not overspending in paying out the dividend. It's in the 98th percentile of high yields in the S&P 500. And in fact, if you look at the forward dividend yield, i.e. the analysts think that some of those high dividends are going to be cut, it actually comes second only to an oil and gas producer, which I've forgotten the name of, but obviously oil has had a pretty crazy ride in 2020, and that it comes second in the S&P 500 for high dividends. Okay, so why are these high dividends particularly important? Like, obviously, high dividend is great, but why do I think it's particularly important at the moment? Number one, we've had crazy low interest rates. Interest rates have been cut all around the world to try and stimulate the economy following the COVID pandemic. Plus, loads of baby boomers are retiring, right? A lot of people, particularly in the Western economy, they're kind of between the ages of 60 to 65, and a lot of people are retiring in that sector. Think about people like pilots who they might have a net worth between $500,000 and $2 million. They're going to be going to their pension funds and they're going to say, I want to switch up my capital appreciation high risk portfolio to an income portfolio because I want to be taking out regular withdrawals because I now want to live on my retirement and what I've built up over the years, right? So these two factors mean the pension funds are going to be desperate for yield. But guess what? They can't find it because interest rates are so low. And Altria is 8.2% dividend yield and very stable, fully covered by both earnings and free cash flow. And that's considerably less risky than any corporate bond with this kind of yield, any corporate bond at all. Like, in order to find a corporate bond with an 8.2% yield, it's going to be an incredibly high risk corporate bond where you might not ever get your principal back, and the lender will default on the loans. Okay, so free cash flow dividend cover is 1.3, and also earnings cover is 1.3. Altria are very efficient at converting their net profit into free cash flow, which is why you see the numbers the same. Dividend payout ratio, currently 77.7%. This is very important because in the Q4 earnings transcript, Altria have been talking about this for some time. Their target dividend payout ratio is 80%. So the yield is 8.2%, but they're below their target dividend payout ratio of 80%. I just think that's absolutely nuts. They say, we believe our dividend target payout ratio provides significant shareholder return while allowing flexibility in our capital allocation. And interestingly, so the preliminary results just came out for 2020. So these are the 2020 results you can see in the bottom left of your screen. And you can see the EPS went up by 3.6%. and the dividend per share only went up by 2.4%. So it's very, very interesting, because this means that Altria are still not going to be at that 80% because their EPS has gone up more than the dividend per share. The reason why they didn't increase their dividend more is they've also started a massive share buyback program, which will obviously also raise the dividend per share, which I will talk about later on in the presentation. So the reason why these high yields are so exciting is, sure, like sitting down and getting 8% is great. But what if the market needs income? Say if it bids Altria's share price up to 4%, sorry, so the dividend yield down to 4%, the share price is going to have to double to accommodate that yield, right? Because yield is just the dividend per share divided by the price. So investors could make 100% capital gain, and they'd be sitting on 8% yield in the process while the market realized that this share was cheap. It's also very, very undervalued through cash flows and as well. I'll talk about my undervaluation models later on in the presentation. Okay, so here's some more evidence. So here's a table I made. This is a very, very strict, high quality dividend filter that I have. It doesn't screen out for the highest yields. It screens out for very, very high quality companies that also pay dividends. Usually about 50 companies pass it in the US market out of about 5,000. So about 1% pass it. It's very, very strict. I don't want to give away the exact metrics, but it's basically things like dividend cover, dividend growth, EBIT margin, return on capital employed, things like that. And you can see Altria absolutely smashes it. It's almost double the dividend of any other companies that pass the screener. Why? Because most companies that have a very, very high dividend are very, very high risk. That's why the market has allowed the dividend to be bid down all the way to that yield. And you can see it. You can see the yield here. Historically, it was about 4%, but the share price of Altria dropped quite a lot. We're going to talk about that on the next slide. And the yields are being bid up and bid up. Okay, why the share price decline? Why is this yield so high? Why? It's predominantly to do with ESG. So ESG is this massive movement. It stands for environmental, social, and governance. And it basically means that you have analysts shunning stocks that are in unethical industries, and tobacco is usually the first to go. You've got the millennial generation coming in. They might be making a bit of money. They're approaching the idea of investing in funds, and they're going to financial advisors, etc., etc. And there is a lot of demand for ESG. So the share prices, it's been a whole trend across the tobacco sector. You can see kind of the big four tobacco companies. There's one in Japan, but these are the big four in the Western market. You can see their share prices have declined a lot. From 2017, we saw this big price reversal. Here's Altria at the top right. And the thing with ESG is that a lot of these funds, they're almost like passively ESG. A lot of them focus on exclusion rather than inclusion. And we're just like, boom, no tobacco, no oil, no gambling stocks. And the prices of these tobacco stocks went down. There was also the JUUL write-down, which might have had a negative effect on the share price, which I'll talk about in a couple of slides. Okay, so terrible graph, terrible fundamentals. Actually, no. So here I've plotted the annualized change over 3 years for these big four American tobacco stocks, which I showed you on the last slide. So this isn't how much has changed over the 3 years. This is how much over 3 years, but on an annual basis. So you can see for all of them, the turnover is up. The EBIT is up, 8% annual for Altria. Operating cash flow is up, free cash flow is up. I've also included debt to just show you that these gains weren't being funded by massively increased debt. As you can see, there's not been much of a debt change. Altria took on a little bit more debt to help them pay for the JUUL acquisition, but the debt position of these companies has been relatively stable. So they've all improved fundamentally. Philip Morris has had a small decline in EBIT, but fundamentally they've all improved. Why they're still growing? Because you must be thinking, tobacco, surely it's a dead industry. The young generation don't smoke anymore. Why are these still growing? It's a common misconception that the turnover of these companies are going down. It's not, it's going up. You can see Altria's turnover is pretty low, but actually their turnover for 2020 is looking very good. And I'll talk about that in a couple of slides. Okay, why is the turnover going up? The increase in the price of cigarettes is offsetting the decline in consumption. So yes, there is a decline in consumption. The amount of people that are smoking is going down, or at least it was before COVID happened. But anyway, you've got the increase in prices is greater than the decline in consumption. And therefore, when you level those things out, the turnover continues to grow. Yeah, and you can see the turnover for Altria. This doesn't include any wacky acquisition stuff or anything. This effectively just includes, it literally just includes core cigarettes. That's literally it. It doesn't include any of the turnover from any of the businesses that Altria's bought. And you can just see, look at this stable increase here. 16, 17, 17, 18, 19, 19, 19. Like, it just shows you the stability of a business like cigarettes. Again, I'll talk about that on the next slide. Yeah, that's pretty much it for this slide. Okay, so Altria's business model, a few things to talk about here. It's very easy to understand. That's another benefit of these companies, is that you want to be investing in something you understand, and Altria is a very easy business model to understand. They sell cigarettes. They sell a highly addictive, low-cost item, and that makes the company very non-cyclical. If it's a recession, people will still tend to buy cigarettes. It's not something that would vary a lot, depending on how the state of economy is doing. Thinking about cars and automotives, right? If there's a massive recession, people are probably going to buy less new cars. But with cigarettes, because it's such a low ticket item, and also people are addicted to cigarettes because of the nicotine aspect, it makes cigarettes a very non-cyclical market. They do very well even when there's a recession. So it's quite interesting. I always like to talk about economic moats when I do these presentations. And Altria have gained a very large economic moat, along with the other tobacco companies. They all have pretty good economic moats because of the ban on cigarette advertising. Think about what happens when you ban advertising on cigarettes. It means that, number one, the new entrants, they can't get into the market, right? It's very hard. How are you going to grow a tobacco company without any advertising, plus with all the regulation that's in there? How are you going to appeal to new customers? You're not. So effectively it means is that these large tobacco companies, that's why you see 4 of them controlling pretty much all of the Western market. That's why these 4 of them still exist. They have very wide economic moats. The other thing is that obviously when you've got bans on cigarette advertising, it makes very stable market share for these companies. Again, that contributes to the stability in turnover. If you're not really advertising, you can't really compete with each other. And basically what will happen is that someone who's smoked X brand of cigarettes for 5 years will smoke the same brand for another 5 years. There's nothing pushing the consumer around to change. You know, if your sister got you into Marlboro cigarettes at age 18, then you're probably going to stick with the same. And Marlboro is the brand. I think I mentioned that earlier. Marlboro is the main cigarette brand that Altria own. So you can see this reflected in the evidence. If you look at the bottom right, you can see the smokables product segment. This is Marlboro's retail share. Look how stable that market share is. 42%, 42%, 43%, 43%. There's very little variance in it. So all of this, basically, it means that the share price is very stable. Wide economic moat, stable turnover, non-cyclical. It means Altria has a very low beta. So its volatility of its share price is lower than the general market, which is evidence to show that it's a very defensive stock. Okay, so Altria had their Q4 earnings call very recently. Their full annual report is coming out on the 25th of Feb. Very excited for that one. Okay, so that earnings call came out last week. I'm doing some analysis on this at the moment. So very interesting. Their revenues grew by 5%. This is very interesting because usually they grow by 1%. Remember, I looked at 3-year annualized turnover for Altria, 0.8%, right? Now we see 5% year on year. In last year was 0.9, year before that 0.7, but 5%. And if it wasn't for the taxes, the excise taxes on cigarettes, it would have grown 6.5%. That was something I wanted to point out as a risk. I'll explain a little bit more later. But obviously one risk of this is that if the US government, because Altria is a just purely US company, keeps increasing its excise taxes, they do eat into Altria's revenue. But they still managed to grow it pretty high, 5% growth. Why is this happening? Effectively, COVID has been a tailwind for the cigarette market. What I mean by that is that COVID has actually helped Altria's business, which I think is a little bit ironic considering COVID is a respiratory disease. But basically, think about what's happened. So you have higher unemployment rates, you've got a lot of people on furlough, a lot of people on work from home, and it's basically meant that it's much easier for people to smoke, right? Obviously, since we've had bans on where you can smoke in the past 10 years, it's very difficult to find that regular smoking break at work. You know, in the 1970s, you could all just smoke indoors at your desk. and now you can't do that. But when you're working from home, there's much more flexibility. So it's increased the rate of cigarette consumption, which is now almost positive. As I mentioned earlier, cigarette consumption has been declining. The increase in prices has offset that. But with COVID, we've actually seen the rate of consumption decline decrease, if you see what I mean. One point I should have mentioned earlier, Altria, they're exclusive for US. If you look at the Western market, basically Morningstar did this research where they were looking at where cigarettes were still very cheap in the Western market, and the US was like the second highest company, which is great for Altria. In the UK, where I'm from, cigarettes are pretty expensive, but in the US, there's still a lot of scope to actually increase the price of cigarettes because it's very low compared to people's wages. So that was that, and you can see the total industry, there's been an increase. However, you know, this might just be a temporary tailwind we see from COVID. We don't know how long it's going to last, but it is very impressive to go from 0.8, 0.9% increase in revenue to then 5% increase in revenue. So the other things I wanted to mention, JUUL and Cronos. So Altria, I remember when I read the Morningstar report on this, and the first line they said, Altria is no longer a pure play on US cigarettes. And I thought, boom, because what's happening? A lot of people where cigarettes are declining, they're going into other markets. They're going into vapes, into e-cigarettes, which is JUUL, and they're also, hopefully, eventually, maybe, depending on how Biden sees this market in his presidency, going into cannabis as well. So Altria have got a 35% stake in JUUL and a 45% stake in Cronos. One thing that might have sent the share price down of Altria a little bit more is Altria overpaid for this stake in steak. I've written steak. Steak, spelled E-A-K, in Cronos, which has had a major write-down. So JUUL is popular in the US. It is very popular, but they've received a lot of lawsuits, which is why the valuation of it's gone down. A lot of people weren't happy with the way they were advertising, etc., etc. But they've had a new CEO come in, he does seem very capable, and he's trying to turn JUUL around, and we'll see how it goes for them over the next couple of years. But as I said, anyway, JUUL, they're not included in Altria's core business, core revenue. They just have a massive stake and some controlling interest in the company. The core business of Altria is still doing well. I see JUUL and Cronos as an added bonus. If it doesn't work out, that would be a shame. If it does work out, it's going to be really, really great for the company's growth. Okay, so on to the valuation of Altria. This is a discounted cash flow model. I'm going to do a video about this pretty soon, detailing exactly how to do this. But basically, I'm summing up the cash flows, and Altria's shares look very, very cheap. Present value $70. It's currently trading just shy of $41, giving us 73% return if this DCF turns out to be true. And what's crazy about this DCF is that we're using declining cash flows. So the analysts, these are the average analyst projections of the cash flows. We're actually using declining cash flows for Altria, which I think is crazy. It's absolutely crazy. So 2022, they're forecasting 20% decline in free cash flow. But even with these declines in free cash flows, there's upside of 73% on the shares. I just think that's absolutely nuts. I really, really do. Let's look at dividend discount valuation. This one is even more generous because it's a dividend stock. I built a dividend discount valuation. 147% upside on this one. This is crazy. It's saying the shares are worth $100. So we can see the dividend increases. As I mentioned, it's been very, very good and very, very sustainable for a while now. And the analysts are forecasting between 4 to 6% dividend growth. And then for me, I put in 3.5%. I wanted to get in at the lower end of this range, just to kind of make sure. And then the long run growth rate of a dividend is 2%, which is pretty much in line with the growth of the US economy. So that's reflected after 6 years. And just summing up the dividends alone, it gives you an intrinsic valuation of $100. I should just mention as well, this doesn't just mean increase in dividends. Altria have also started a share buyback program over the next couple of years. And obviously what that will do is that when Altria buy their shares back, they reduce the amount of shares outstanding, so then the dividend per share is higher and growing. And that will help to increase the dividend per share as well. Okay, so moving on to the sell side now. So I just wanted to talk about sell side and relative valuation. The analysts are actually quite bullish on this, which is quite interesting given how much they've shunted it for being a sin stock or a non-ethical stock recently, which is good. From the ratings I could find, there were no underperforms or sells, mainly buys and a few outperforms and quite a lot of holds as well. Relative valuation, this is always really important because with Altria's business, right, like I would say that the higher valuations are justified now compared to 5 years ago because the turnover is growing stably, but we've seen the tailwind from COVID, which is giving a temporary boost to revenue, and also we're seeing these growth prospects where Altria are buying big stakes in growing sectors like the e-cigarette market and tobacco. So I would say that the price to earnings and price to free cash flow would be probably justified to be a little bit higher than it would have been, say, over the average of 5 years, but it's not. Look at this, PE of 8, 5-year average 17, price to operating cash flow 4, 5-year average 22. 8.4, price average 22, price to free cash flow of 8.7, 5-year average 22.6, and the dividend yield is almost double. It's absolutely nuts. Compared it to the sector as well, Altria look cheap, and compare it to the country, it's just crazy. I would say probably the most useful for this would be to compare it to the 5-year average. What's changed for Altria? Not much fundamentally, as I said. I think they're in a slightly better position because of the temporary tailwind, which is COVID, and also the growth acquisitions in JUUL and Cronos, which is crazy, absolutely crazy. So yeah, just some technical stuff. This isn't my most used area, but I would like to cover it anyway. So we've seen a long-term downward corridor in the share price. This is just since the price reversal of May 2017, because obviously we want to try and work out when these shares will reverse in price. So this is when we saw the price reversal. We've seen this long-term downward corridor that the share price is trading in. And it's interesting actually, because in the past couple of months, we've actually seen a sustained share price above this corridor, which is interesting because obviously we haven't seen that since 2017. And the share price is currently just above both the 50 simple moving average and the 200 simple moving average. So it's going to be interesting. Those are what the technicals say. As I said, I do see a lot of caps downside on this because of how high the dividend yield is and the fact that we're not going to see cuts. And literally in the earnings call that came out last week, we're seeing a dividend raise of 2.4%. Okay, so in conclusion, Altria is a stable and growing non-cyclical cigarette company with an 8.2% yield. It's got exposure to new and exciting markets such as vapes with JUUL, as I mentioned, and also cannabis with Cronos. So COVID has helped their business a lot because more people are at home. It's just easier for people to smoke. The risks I went through, dividend cut would be a risk because I don't think the share price would have the same floor. But that's highly unlikely because they're below that 80% target payout ratio. We saw a dividend increase, just literally last week. And also they've just started a massive buyback share program. So I really don't think we're going to see a dividend cut, particularly with the stability of the turnover and the tailwind because of COVID. Another risk, Biden regulating the vaping market, more excise taxes on cigarettes. Biden regulating the vaping market, I don't think that's his top priority at the moment. I really don't. He's flirted with the idea in the past, although I don't think he's mentioned anything seriously. We'll have to see. Again, I see JUUL as an added bonus and not a core part of the investment thesis. But if JUUL goes well, that's great for Altria investors. More excise taxes on the US, I think we will see that. I don't think we'll see anything drastic, but I think we'll see an increase over time, which is something that you have to keep an eye on. But even with those excise taxes, all of these tobacco companies have still been managing to grow their turnover. And as I said, Altria has grown it a lot in 2020. Stock is hated because of ESG. Yes, this is a big risk because this is why the share price has been going down for the past 5 years. And if Altria's dividend yield was 3%, I would say yes, this is a risk. The key question is the amount of pension fund inflow we're going to see into Altria, does that outweigh the stock being shunted for ESG? That's what we've got to weigh up. If a dividend yield was 4% and you can go and get a 4% yield off another company that's not being shunned by ESG, then sure, I would say that is a massive risk because why would they go for Altria? But with 8.2%, like it coming double of anything else of my filter, being a safe dividend yielding company, it having the second highest forwarding dividend yield in the S&P 500, only second to an oil and gas company, which have seen massive headwinds in COVID this year when the oil demand has been practically nothing because nobody's flying their planes or driving their cars. I just think that's crazy for such a stable company to be second highest in the S&P 500 for forward dividend yield. I think it's crazy. And here we see the chart. You know, the long-term yield was 4%, and now it's going to go up and up and up. So this provides a massive floor, and as soon as pension funds realize this, I think we're going to see a massive share price increase, and that's where the investors not only benefit from the high dividends, but also the capital gain. Valuation. So the current share price is just shy of $41. 5-year average price to free cash flow. As I said, I think the 5-year average is justified because I think that high valuations are justified compared to the past for reasons I already mentioned. $104 if you do the average price to free cash flow over 5 years. That's what the implied share price would be. 156% upside. My discounted cash flow up 73%. That was a very, very conservative discounted cash flow. The dividend discount model, very similar to the 5-year average price to free cash flow, $101. And then if you talk about it just getting back up to 5% dividend yield, which I think would be where we would see the market bid it up to if it was purely just this income play. If Altria's dividend yield was 5%, that implies a share price of $68, which still gives you a very nice upside of 67%. Plus, you can sit down and you can collect 2% dividend yields quarterly, 8% annually, whilst you wait. So yeah, that was the investment thesis on Altria. I really hope you guys enjoyed it. I had a lot of fun putting that one together. As always, this does not constitute as financial advice. This is solely for educational purposes. Go invest in companies at your own risk. Any questions or recommendations or ideas you have, stuff you want to see, please pop them in the comments. And until next time, take care and happy investing.